Hello, everyone. So today we are going to talk to you about lease accounting, which is Ind AS 116. Now, Ind AS 116 is actually a very new accounting standard, and this has been issued in a way to comprehensively, um, what do I say? In a way, this is this is actually changing the whole concept of lease accounting, what we've been learning so far, right? Or what we have learned so far under the old Indian accounting standard or under the old Ind AS 17, which was prevailing prior to this. So there was a complete overhaul from a lease accounting perspective as far as it is related to lessee. So leases were up till now were considered as an off balance sheet item. So what has actually changed, right? So leases, unlike property, plant and equipment, were always considered as an off balance sheet item. So where I entered into an arrangement to start using a property, but since I am not the owner, I pay the rent. That property was never reflected in my financial statement, and it was always there in the balance sheet of the lessor, unless it was like a finance lease arrangement, and we will talk about all of that. So when you think about lease accounting, there are several players which comes to our attention, whether you are a lessor, the guy who owns the asset, you are a lessee, the person who's going to start using the asset. And then what are the arrangements? What are the nuances of the arrangement between the lessor and the lessee? Now, all of that has been comprehensively addressed as part of Ind AS 116. And as I said, it's a new accounting standard. It has comprehensively, in a way, overhauled the existing accounting guidance. And this was done in a way in order to address a big gap, is to say that if I have two different business models, even though I'm doing exactly the same thing, my balance sheet and my P&L used to look very different, right? The end of the day, your cash position may be the same, right? Cash flows may not change fundamentally, but your P&L and balance sheet used to look very different. And this is, in a way, an attempt to try and reduce that gap to the extent possible, right? And that's what we will try and understand at a fair degree of detail, in a way, from that perspective. So why is the need for the standard? So some of the key, in a way, consideration is what we will try and learn and understand. What's the meaning of lease, right? What's an identified asset? So the moment you're talking about a lease, there has to be an asset which has to be at play, right? So asset could be your land, building, your plant and machinery, furniture, vehicles, tangible asset. We're talking about tangible asset which are actually being leased, right? Then lease term is what's the period? Lease term means that what's the period for which you giving the asset on lease to the lessee. So between the lessor and the lessee. And then we will talk about substantive substitution right. And I'll try and explain to you with the help of an example that what's the meaning of a substantive substitution right. So to put things in perspective, so if for example, you hire a car, right? You're taking a car on rent, and if the owner of the car has the ability to actually send not a X car, but it can also send a Y car to meet your requirement. Now, that means that the owner can actually substitute X with Y and still fulfills the contractual terms, right, of the arrangement. That means that the owner or the lessor has substantive substitution right, and hence that's not a lease arrangement in the context of lease accounting or in the context of Ind AS 116. It's just a vanilla agreement to hire and obtain certain services under that contract. And we will talk in a lot more detail. So how to identify and separate the lease and non-lease component of a contract. Now, what are we trying to say here? When we say lease and non-lease means, let's say you're trying to take a building on a rent. Once you take a building on a rent or a flat on a rent, there is a maintenance which is attached to that flat, right? So the question which comes up is that the flat and the maintenance. So the rent, what you're paying for the flat, that's actually covered as part of Ind AS. That's a lease component. But what you're paying for maintenance is not, covered under the lease arrangement. But then that's why it is called a non-lease component. And we need to understand the accounting nuance between the lease and non-lease component. There are very unique, in a way, accounting requirements around that, and we will talk about it. What's the criteria for recognition of a lease, right? When do you record lease as part of your financial statements? What's the impact of that accounting in the books of the lessor? How does this impact the accounting in the books of the lessee? All of that is what we will try and talk about. What is the concept of inception and commencement of lease, right? Many times what happens is that you sign up a lease contract today, but you don't have access to the premise for XYZ reason. It may be still in construction, some approvals may still be required, or you may have said that, let's sign it up, but, I'm going to start occupying this after 3 months, right? So how do you, in a way, look at that? Is there an accounting impact of, the difference, if there are differences between the inception and the commencement of the lease? And then how do you deal with the subleases and sale and leaseback transactions? So the sale and leaseback transaction we see commonly in several industry, and most notably is the airline sector, where you see the sale and leaseback, right? Sublease is again, you see commonly, where, let's say, a lot of these guys, right? The co-share office arrangements, right? Where companies do take offices on lease, and then they're leasing it, subleasing it in a way. So I am not the owner of the premise, but I've taken it on lease, and then I'm trying to make some business out of that. So I, let's say, taken on lease for 50 rupee a square feet. And then I'm trying to rent it out, to other guys for 60 rupees a square feet or 70 rupees a square feet. In a way, I'm trying to make money out of the same process. So that, in a way, is a sublease arrangement. And again, we will try and talk in a lot more detail as to how the subleases needs to be dealt with from accounting perspective, right? From accounting perspective. So very quickly, looking at the importance of the topic. So the topic's been important. There have been instances which I see when this has been covered in examination, though not a great deal, right? We don't see that this topic's been covered too many times, right? But my sense is now, since it is a new accounting standard, and it has much greater impact now as far as your financial statements are concerned, and the standard is also new. So my sense is that the trend will change, okay, and it is likely that there will be more questions on lease accounting in future examinations. So you have to understand and in a way get a good perspective on the accounting nuances, on the principles of Ind AS 116, both from a lessor perspective, the person who owns the asset, lessor, and the lessee, the person who's taken the asset on lease to use the asset or sublease the asset, or when you own the asset and you're trying to do a sale and lease back, right? So all of that is what we need to try and understand. My sense is that this topic is important. This topic is important, right? And you should understand this. This is not a complex accounting standard, I would say. But what happens here is that because there are a number of policy choices which are made available, and there is a lot of computations involved, right? One is the principles. Principles are easy to understand, and we will talk about that. But when you comes to, in a way, compute the outcomes under the standard, there's a lot of computation in a way which needs to be taken care of. Then there are balance sheet presentation matters, there are P&L presentation matter, which has an impact on profitability, which has an impact on your disclosures, and all of that in a way makes this standard important, right? In a way makes this standard important. And after the change, we've seen balance sheets of companies in a way becoming bulkier, right? Or becoming heavy by 5 to 8%, right? It is a significant impact on the size of the balance sheet of many companies which are following Ind AS as an accounting framework. And they have lots of leases in a way as part of their business model. So if you have lots of leases as part of the business model, remember what I said is previously it was considered as an off balance sheet arrangement. That means you are only required to make certain disclosures. It was not recorded as an asset or a liability in your balance sheet. Now that has changed fundamentally under Ind AS 116, where all these arrangements, in a way, which is a life of more than 12 months, all these arrangements, which is a life of more than 12 months, all of them in a way are required to be recorded as part of your financial statement. And we will talk a lot more about the same. So it is effective from April 1, 2019. And that's where, as I said, the curriculum is also now being updated. And it's going to start coming in the curriculum, I think, from November 2020 and beyond. So you will see in a lot of kind of focus and attention onto this. Of course, Indian companies have already applied this, right? Indian companies have already applied this in their first reporting for March 2020. March 2020, any company which is required to follow Ind AS has already applied Ind AS 116, which is effective from April 1, 2019. So what are the broad principles of the standard, right? Lessees will have a single on-balance sheet accounting model for all leases, with exemption for short-term leases and leases of low-value asset. So if you remember that previously, from a lessee perspective, leases were considered as two types of leases: finance lease and operating lease. Now that distinction has been done away with, right? There is no more evaluation that whether a lease is a finance lease or an operating lease. A lease is a lease, okay? Except for leases which are short-term leases. And I said short-term is being looked at from a standard perspective, leases which are less than 12 months, okay? Leases which are for less than 12 months, and leases of low value assets. Low value assets, the standard hasn't defined a threshold that what is low value, right? And that's where some judgment and the accounting policy choices in a way do come in handy to say a company, let's say, may set up a threshold to say asset costing, let's say 10,000 rupees or 20,000 rupees, that may be considered as a low value asset. But we haven't defined any monetary threshold in the standard. I think that's important to understand. In the IFRS, they have talked about $5,000, right? $5,000. So, but we haven't talked about a threshold in our standard in a way from that perspective. Lessor accounting is substantially unchanged, except one area where we see an impact, which is that in difference to Ind AS 17, is that if you have given an asset on lease and there is the rental is actually changing over the lease terms. So for example, in year 1, if you're charging 10 rupees, in year 2, you are charging 12 rupees, and in year 3, you are charging 14 rupees, right? So essentially in all the 3 years put together, which is 14 plus 12 is 26, plus, 14 plus 12 plus 10, you are making 36, right? Divided by 3, in a way 12. So, so if you're making actually 12 rupees per annum, but you have structured your lease payments as 10 rupees in year 1 and 12 in year 2 and 14 in year 3, the Ind AS 17 has actually allowed you, provided you can demonstrate that this increase is actually, reflecting the inflationary scenario in that particular jurisdiction, then you are not required to do straight lining of lease rentals. Now that is what has changed. That is what has changed under Ind AS 116. Now the lessor is required to do straight lining of lease rental. So in a way now lessor will be required to record 12 rupees as income in year 1 as well. And we will talk a lot more about this, right? Implementation of the standard could require an entity to develop new processes and controls or adjust existing one to identify and account for these. What are we trying to say here? What does it mean? That let's say today the amount of processes or controls we see in any company in relation to a fixed asset, right? Because it is owned by the company and it is recorded as a fixed asset in the balance sheet of the company. There's a fixed asset register. All of that is being maintained. There's a procurement process, there's an authorization process, there's a proper disposal process. All of that is actually being laid out in relation to a fixed asset which is owned by the company. That is possibly at that similar type of processes and controls. Now companies are also required to set up for lease assets as well, right? Up till now, lease assets were not recorded as part of the balance sheet. Now that has changed, right? Now, if the lease asset were to come into the balance sheet, that means that if I don't record an asset appropriately, my balance sheet is misstated. If I don't record the amortization appropriately, my P&L is misstated, so on and so forth. And hence, if an asset is now on your balance sheet, you need to demonstrate control, over that in terms of safeguarding of those assets, right? So I think a company needs to look at this whole area because of this new standard, and kind of put in a strong and robust, in a way, controls. Lessees and lessors will have additional disclosures. So now, since there is a significant impact, this will result into incremental disclosures. And remember, Ind AS is, more about disclosures, and disclosure. It's a principle-based accounting standard, right? It's a principle-based accounting standard. The new standard is also likely to have broad implication for entities, finances, and operations, because suddenly, you have an asset, which is, and you have a liability, which is as part of your balance sheet, and then the debt has gone up, and an asset is recorded in the form of intangible asset, and we will talk about that. So from a company perspective, your debt equity may undergo a change, your interest coverage ratio may undergo a change, your your EBITDA, which is earning before interest, tax, depreciation, and amortization, that will change. Your profitability may change in respective years, though over the life cycle of the lease arrangement, your profitability will stay the same. But in the intermediate period, your profitability is likely to change, right? Similarly, it identifies arrangements that are to be accounted for as leases. Many times what we see, that there are service arrangements, right? In a way, they are not designated as a lease arrangement between the two parties to the contract. But when we look at in substance of those arrangements, that in substance the arrangement in a way involves deployment of an asset, and that asset in a way is identified as part of that contractual arrangement, which can be identified explicitly or implicitly as part of the arrangement, right? And then we are saying that there are no substantive substitution rights also with the counterparties, and hence they in a way are not being called as leases, but they are actually in substance a lease arrangement, right? And that is where we need to evaluate those arrangements, complex arrangements, and then take a view to say that whether they fall under the four corners of lease accounting, and the implication around the same, in a way from that perspective. So we will talk about all of that in great degree of detail. But before that, let's talk about the scope, what all is covered and what all is not covered as part of the standard. And I'll just take a pause here. So now we will talk about the scope. And the scope is fairly wide, right? Scope is fairly wide. So when we look at what type of arrangement this is applicable, right? So the standard is applicable to all lease arrangements, except, so what are the scope exceptions, right? So remember what I had said in the past also, right? So if you have a specific accounting standard for a specific type of transaction, then you go to that accounting standard, right? Similarly, so if you have a leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources, then you go to Ind AS 106. Or if you have to deal with biological assets, you go to Ind AS 41. Or if you are in a service concession arrangement, right, then you look at the Appendix D of Ind AS 115. If there are licenses of intellectual property, right, then you again look at them under Ind AS 115. If there are matters which are covered under Ind AS 38, right, which is a standard itself on intangible asset, then you go and deal with this under the Ind AS 38 model. So in a way, a lease may but is not required to apply Ind AS 116 to leases of intangible assets other than those specifically excluded from its scope. So we've had some very interesting conversations. So when you look at this last bullet, right, what it says is rights held by a lessee under licensing agreement, such items as motion picture films, video recordings, plays, manuscripts, patents, and copyrights, right? Then the question comes, if it is not specifically written, are softwares, right? Are they covered under Ind AS 116 or they are covered under Ind AS 38 for that matter, right? So that's an interesting debate. I think the position is that for software, it seems that it is an accounting policy choice, that whether we want to apply Ind AS 116 to software arrangement, because that is not specifically excluded, so if it is not specifically excluded, but it is in a way is an intangible asset. So when you look at a lease accounting is generally meant for tangible assets, right? And what are those tangible assets? It is land, building, plant and machinery, furniture fixtures, motor vehicles, right? Computer equipment, so on and so forth. So all assets which you can touch and feel, right? But if it is an intangible asset, you are excluded. If it is exploration of mineral rights, you are excluded because that's covered under Ind AS 106. If it is biological asset, then you're excluded because that's covered under Ind AS 41. If it is service concession arrangement like toll roads, right to operate the toll roads or airports or those matters in a way which are covered under Appendix D to Ind AS 115, or we look at license of intellectual property granted by lessor under Ind AS 115. So for specific matters, if there are specific standard, then those are being scoped out. Otherwise, you are very much covered as part of the standard for all lease arrangements which are in relation to, in a way, tangible items, right? Tangible assets. And a very, kind of exception which see is in relation to computer software. I think that's where there is some accounting policy choice. And also remember, we talked about in terms of the application of the standard, subject to certain policy choices which are available for short-term leases, which are leases which are less than 12 months, right? And for leases which are of low value, right? And as I said, that no threshold has been defined, and companies and organizations needs to define that threshold to say if it is, let's say, less than 10,000 rupees, I may not apply lease accounting and deal with this in the usual course. All right. So let's now talk about the lease definition. What's the meaning of leases, right? What all is covered as part of the standard, from that perspective. So what is a lease? Okay, what is a lease? So as I said, when you think about a lease, a very simple example you can think about is in your own situation, right? You ordinarily rent a flat, right, where you stay, unless you're the owner of that flat itself, or a house or a building, right? That's the most common example which we see, right? And then if you are doing a business, you may want to rent an office space, right? Or you may want to rent, let's say, motor vehicle, right? Automobile is what we see, very common example of leases. Is what again we see. You may lease air conditioners, for example, right? So all of that is possible. All of that is possible. So any arrangement in a way in which the ownership of the asset is not getting transferred to you by default at the end of the lease term, right? That is a lease arrangement, right? So you many times you may have a right to actually purchase the asset, and that's where we see bargain purchase option or and things like that. And that in a way is also a subtle difference between hire purchase and leases, right? When you look at hire purchase, in a way you are the owner of the asset, hire purchase, but it's like you purchase the house and then you've taken a loan from a bank, right? That's largely a hire purchase, and if you default, then the person who's giving you the finance can actually take a repossession, right? Similarly, but not in case of lease, the title of the asset stays with the lessor, right? There is no transfer of title from the lessor to the lessee. The lessor continues to be the owner of the asset, right? I think that's one big difference, and there is no automatic transfer of title also at the end of the lease term. So we will try and understand the definition of lease. A lease is something which is a contract, right? It has to be a contract between two counterparties. Contract is or contains a lease if the contract conveys the right to control, and that's very important, contains right to control the use of an identified asset. So right to control the use, right, of an identified asset for a period of time, which is the lease term. There has to be a period of time in exchange for consideration. So what does that mean? So if you are a lessee in a way, and so there are two parties required, right? Two parties required, lessor and lessee, right? There are two parties which are required as part of this arrangement. So there has to be a transfer of control over that asset from lessor to lessee. Okay, that's step number one. Now, that transfer of control in a way should be able to enable the lessee to use the asset, right? It's just not that it is in your control, but you can't do anything about it, right? That doesn't help. So it has to be in my control, and also I should have the ability to use, right? And then what is to be in my control? An asset, right? An asset, which is an identifiable asset. Many times the asset may be explicitly identified or maybe implicitly identified, that you've not identified them explicitly, but it is there as part of the contractual arrangement. I know this car, I know this building, I know this office space, I know this plant and machinery, right? Which cannot be substituted, right? um, for a period of time, right? For a specified period, which is term, right? It could be, it has to be ordinarily, if it is less than 12 months, then you get an exception, even though it is a lease arrangement, but there are policy choices available, which is like called short-term lease. So assuming it is more than 12-month period of time, ordinarily means more than 12 months. And of course, if you're getting a right to control, to use it for a period of time, then you got to pay, right? So there has to be an exchange of, it has to be a commercial transaction. So there has to be a commercial consideration in a way being involved. So if I were to look at it simplistically, leases, for that leases, there has to be an identified asset and there has to be right to control the use. Okay, there has to be an identified asset and there has to be a right to control the use, right to control the use. And the identification can be explicitly or implicitly, with no substantive right to substitute. And I talked about this substantive right to substitute means, and we'll talk about a lot more on this. This is important, right? And I gave this example of this taxi services. So if you have taken a taxi on hire, and if the taxi driver or the agency from where you're going to take this taxi on hire, they can send, let's say today, say, Suzuki Desire, right? Maruti Desire, say today XYZ, and tomorrow they can say ABC, same Desire, but with a different number plate or a different registration number or a different chassis number and so on and so forth. That means they have a right to substitute the asset till the time it fulfills your requirement. If that is the case, that's not a lease arrangement, okay? It has to be the same asset. It has to be the same asset, same identified asset. It's not the similar assets, no, it has to be the same asset for this to qualify it. You can have some substantive, you can have some substitution right, but that has to be only an exception. For example, if there is a damage to the car which was actually leased to you, then the taxi agency can actually send you a replacement, right, for the intermediate period, or for the balance period, so on and so forth. But there has to be a very, very strong reason, for that substitution, and you should be then paying for it as well, right? An incremental amount for substitution rights. Right to obtain. So if it is in my control and I have the ability to direct the use, then I should also be entitled for all the benefits, right? So I have the right to direct the use, and I also have the right to obtain all economic benefits. So often it's a matter of judgment. Many times it's very clear that that's a lease arrangement and you are the owner of there is a transfer of control from the owner to the lessee, and for that it is for a defined period, and you have the ability to direct the use, like you've taken up rent on flat on rent, right? You are in possession, you are using it, you're using it the way you deem fit. Of course, you're not doing it for illegal purpose, for example, right? That's not allowed. Or you're not using it, let's say, if it is deemed for residential purpose, you are not allowed to start, let's say, commercial activity by occupying that property, right? So you have to apply the judgment that for the purpose for which the property has been leased, you've been in a way using that property for a specified period of time, for which you are required to pay consideration, and you are in a way entitled to get all the benefits during that period. In a way, from that perspective, lease to obtain certain arrangements that contain significant services. So we will also in a way look at lease arrangements, which I said, which are not called as leases, but they are in substance a lease arrangement. So what are those arrangements, right? What are those arrangements? We will try and talk about that as well. Okay, so let's now try and understand in a little bit more detail when we say identified asset. What does it mean, right? So asset can be explicitly or implicitly identified. Now, when I say explicitly, that means explicitly it's written that this car, this building, this office space, or this computer equipment, or this plant or machinery, or this piece of furniture, so on and so forth. Okay. Now, there are arrangements where it is not written explicitly, but through the contractual terms and arrangement, you know that this is the car which will come every day. There will be no another car which is going to come, right? So on and so forth. So you got to then look at the substance of the transaction, and why it is implicitly important is because in a way then we are trying to address the substance of the transaction, right? Substance of the transaction. And as from an accounting perspective, we look at not only form but substance of the transaction. So even substance is a lease arrangement, then as opposed to a supply or a services arrangement, then you need to account for this as a lease arrangement, right? So an arrangement only contains a lease if there is an identified asset. An asset can be explicitly identified or implicitly at the time it is made available for lease by the lessee, right? So whenever it is available for use by the lessee, you can look at this explicitly or implicitly in a way from that perspective, right? So let's just try and look at an example for an asset which is implicitly specified in a contract. Let's just try and look at with the help of an example. So customer XYZ enters into a 10-year contract with supplier ABC for the use of rolling stock specifically designed for customer XYZ. All right. So that's an arrangement between customer and supplier XYZ and ABC for the use of rolling stock specifically designed for customer XYZ. The rolling stock is designed to transport materials used in customer XYZ production process and is not suitable for use by other customers. The rolling stock is not explicitly specified, all right, in the contract, but supplier ABC owns only one rolling stock that is suitable for customer XYZ use. And if the rolling stock does not operate properly, the contract requires supplier ABC to repair or replace the rolling stock. That means this is the only rolling stock which is available to me. Now, if that is the case, then what is the situation here? Is this, but so when you look at the contract, it's a supply contract, right? Supply of rolling stock, right? Now, I have not said that I need this particular asset from you, Mr. Supplier. I said I need supply of rolling stock, right? However, the fact pattern also suggests that this supplier is only one rolling stock, right? That's the only rolling stock which is available to you, right? And hence, what does that mean? That is there that means that's the only asset which is available, right? So is this something which is implicitly identified? Now, we're not concluding yet that's a lease or not a lease, right? We're saying, is there in this arrangement, is there an asset which is implicitly identified? Yes, the said rolling stock is an identified asset because this is unique. This is, there is this, you cannot mix it with other assets of the lessor, right? That's the only asset he has. And this is what, I'm going to use it and I'm going to, retain the economic benefit or outcome for which I need to pay a contract consideration, and there is a contract term which is 10 years in this example. So, though the rolling stock is not explicitly specified in the contract, example by serial number, it is implicitly specified because supplier ABC must use it to fulfill the contractual obligation. All right. So now we will try and understand what is the meaning of a substantive substitution right. Okay. So when we think about a substantive substitution right, I already gave you an example of this taxi company, right? An asset is not an identified asset if the lessor has a substantive right to substitute the asset for an alternative asset throughout the period of use. Now, what does it mean? It means that if you have taken an asset on lease, all right, if you have taken an asset on lease in a way, so say asset is asset X, okay. Now, if the lessor can replace this X with either A or either B or with C, for example, right? That means this X is not available to the lessee during the term of the arrangement. The supplier or the lessor has the ability to either send X or A or B or C. That means there is a substantive substitution right. That means there is no identified asset, right? It is only a type of asset which is identified, but not the asset, all right? And that's the difference. That's the difference, okay? So an asset is not an identified asset if the lessor has a substantive right to substitute the asset for an alternative asset, for an alternative here A, B, C, throughout the period of use. So if I have available, alternatives which I can supply. Remember in the previous case, there was no alternative, because that's the only asset I had, right? But here, let's say assuming an arrangement where there is a possibility, right? Then is this an identified asset or not? A lesser substitution right is substantive if the lessor has the practical ability to substitute alternative asset throughout the period. So I have the ability, right? And it is economically feasible. It has to make commercial sense for me, right? So if it doesn't make commercial sense for me, that means that it is not substantive, even though there is a clause which is out there. But why will I replace it? If it is given to me, it's my choice, and I won't replace it because I will be then consuming two of my asset for the same consideration. So why will I do that, right? So I want to retain, there has to be a practical ability as well as it has to make the economic substance, that as a supplier, as a in a way a lessor, I would like to keep on replacing, keep on changing, because that's what business sense for me, and that is what is also permitted under the contractual arrangement. Okay, so evaluation of lessor substitution right should be made at the inception. Again, this is a matter of judgment. If the customer cannot readily determine whether the supplier has a substantive substitution right, the customer then presumes that the substitution right is not substantive. So if the agreements are not very clear, but you are under an obligation to pay, then you will assume that the supplier doesn't have a substantive substitution right, or even if he will not do it because it doesn't make economic sense for him, right? So it's a you have to look at both, right? There has to be a practical ability as well as it has to make economic business sense from a supplier perspective to replace an already identified asset in a lease arrangement, from that perspective. So let's move forward to talk a lot more about substantive substitution right? So if the supplier has a right or an obligation to substitute the asset only on or after either a particular date. I talked about this, right? That either a particular date or in some circumstances or the occurrence of a specified event, let's say damage. The supplier substitution right is not substantive because the supplier does not have the practical ability to substitute alternative asset throughout the period of use. So remember the requirement is that it has to be throughout the period of use. I should have the practical ability as well as economic business sense, for me to replace the assets, right? Now, if that's not been the case, but it's only triggered because of specific nuances, specified events, then it is not considered, to be substantive. That means then it is a lease arrangement, which you need to look at and in a way consider it appropriately. Now, contract term that allows or require a supplier to substitute alternative assets only when the underlying asset is not operating, right? For XYZ reason, maybe there's a defect, maybe there's an accident, maybe there's a damage, maybe some other factors, right? Or when a technical upgrade becomes available, do not create a substantive. So that's not a substantive because I will not do it otherwise, right? And I'm only doing it because now there's a problem with the original asset. If there's a problem with the original asset, and if I'm under an obligation that I've taken an obligation, I'll keep this asset up and running. Then it continues to be a lease arrangement. So in a way, it comes with the lease as well as the maintenance of the lease asset. In a way, from a supplier standpoint, the perspective, right? And same is from a lessee or a user perspective. I am then assured of the quality, output, uptime of the identified asset, which I have taken as part of this arrangement in a way from that perspective. So moving forward to talk about this further with the help of an example, right? So let's look at this example, which is an electronic data storage provider, the supplier, provides services through a centralized data center that involve the use of a specified server number 10. The supplier maintains many identical servers in a single accessible location and determines at inception of the contract that it is permitted to and can easily substitute another server without the customer consent throughout the period. It is like a data warehouse arrangement for you to host your data. The service provider has number of servers, right? And the contract seems to suggest that the service provider can change, right? Can alter at his convenience without obtaining your consent. Move your data from one server to another server to optimize the use of their own capacity, right? Further, the supplier would benefit economically from substituting an alternative asset because doing this would allow the supplier to optimize the performance of its network at only a nominal cost. In addition, the supplier has made clear that it has negotiated this right of substitution as an important right in the arrangement, and the substitution that affected the pricing of the arrangement. That means substitution is substantive in the arrangement, right? So if you look at the fact pattern, or it says that I am going to provide you a specified server, but I can replace it with another server without the customer consent, and this is economically also, I'm going to benefit this economically from substituting, and I can do this only a nominal cost, and I have bargained for this as well. The question here is whether these substitution rights are substantive and whether there is an identified asset. Of course, there is an identified asset, which is servers, right? There are a number of servers, but is there the identified asset, the particular asset, right? And when you look at the solution, right, what do we need to look at? We need to look at the customer does not have the right to use an identified asset because at the inception of the contract, the supplier has the practical ability, and also it is economically feasible for such a substitution. Thus, there is no identified asset. However, if the customer could not readily determine whether the supplier had a substantive substitution right, okay, the customer would presume the substitution right is not substantive and conclude that there is an identity. So if I can't do this evaluation, then I will then conclude that there is an identified asset. But since in the given fact pattern there's enough information, and it seems it is appropriate, to conclude that there is a substantive substitution right. All right. Now we'll take a pause here before we move to the next topic, which is how do you identify an asset, right? Which are physically distinct from each other. Okay, let's take a pause.